Welcome to The Explainer. Today we're talking about Nestlé. You know them, they are the biggest food company on the planet. For investors, they've been this rock-solid fortress for decades. But what happens when a fortress like that just stops growing?
And that's really the big question we're cackling today. See, if you're an investor, Nestlé has always been that safe harbor stock, right? A real defensive stronghold. But lately, that engine has been sputtering. So to figure out what's coming next, we've got to do three things. First, understand where all its power comes from. Second, figure out exactly what's gone wrong. And third, break down their pretty bold plan to get things back on track.
So, first things first. Before we can even talk about the problems, you have to appreciate just how massive this fortress really is. I mean, we need to get a handle on the incredible, almost unshakable power that Nestlé has built up over all these years.
And at the heart of it all, just sheer mind-boggling scale. We're talking over 2,000 brands. And get this, more than 30 of those are what they call billionaire brands, each one pulling in over $1 billion Swiss francs a year. That's not just big, that's a powerful defensive shield right there.
Now, in the world of investing, there's a term for this kind of defensive power. They call it an economic moat. Think of it like a castle moat, right? It's that sustainable competitive advantage that keeps all the rivals out. And believe me, Nestlé's moat is one of the widest you'll find, and it's built on 3 enormous pillars.
Okay, so let's break that down. Pillar number 1 is brand strength. Names like Nescafé, Kit Kat, Purina. They command huge loyalty. Pillar 2, economies of scale. This is incredible. They buy 10% of the world's coffee. Imagine the cost advantage that gives them. Nobody can compete with that. And finally, pillar 3 is their global distribution. This is a network they've spent a century building, getting their products into every nook and cranny of the globe. You put those 3 things together, and yeah, you've got a seriously strong fortress.
And within that fortress, the 2 strongest towers, so to speak, are coffee and pet care. Look at this. Together they make up nearly half of the company's total sales. But here's the really crucial part for an investor. These are their highest margin businesses. They are the profit engines that power the entire company.
Okay, so we've established the fortress is, it's formidable. But, as you might have guessed, some cracks have recently started to show, and they all point back to one central issue, a real growth problem that has investors starting to get a little nervous. And to really get what's going on, you need to know about a super important metric for investors. It's called real internal growth, or just RIG for short. Now, just for a second, ignore any price increases. RIG tells you one simple thing. Is the company actually selling more stuff, more volume? It's really the purest way to measure if people are actually buying more of your products.
And this is where the problem becomes crystal clear. If you just look at the top line, organic growth, things look okay, right? But look closer. Almost all of that growth came from jacking up prices. The real number to watch, that RIG number, was basically flat and then, boom, it went negative in 2023. What that means is they weren't selling more products, they were just charging more for them and people started to buy less. That's a red flag.
So this put management in a really tough spot. A classic dilemma, especially with inflation running hot. What do? Do you raise your prices to protect your profit margins, but risk your customers switching to cheaper brands? Or do you keep prices low to hold on to your customers, but watch your profits get squeezed? Well, Nestlé made its choice. They protected their margins. And that negative RIG, that was the price they paid.
And here's the bill coming due. Management is now telling investors that profit margins are going to come down way below their long-term target. What they're really saying is, look, we have to take some pain now. We're going to spend a ton of money on things like marketing to win back those customers we lost. It's a classic short-term pain for long-term gameplay.
So that brings us to the billion-dollar question, right? What's the plan? How are they going to fight back and get this giant company growing for real again? Well, the answer is a plan for a massive, massive transformation.
The whole strategy is summed up perfectly in this quote. It's all about a huge portfolio transformation. Basically, they're fundamentally reshaping the whole company, using a strategy you might call shrink to grow. Sounds a little counterintuitive, but let's see how it works.
And let me tell you, this is not just corporate speak. They are putting their money where their mouth is. They've sold off slower-growing businesses like their U.S. water division and confectionery arm for billions of dollars. And what did they do with that cash? They turned right around and plowed it into high-growth areas, buying things like the Starbucks at-home coffee license and a huge vitamin company. The scale of this is just wild. They've actively reshaped about 20% of their entire sales base since 2017.
And it's not just buying and selling businesses. They're also totally revamping how they innovate. You know, instead of throwing 1,000 new products at the wall every year to see what sticks, they're cutting that way back, by half. The idea is to focus all that R&D muscle on fewer, bigger, better ideas. They're making big bets on projects that could actually make a real dent in a company of this size.
And where is all this money and focus going? It's being channeled into 3 key pillars. This is where management sees the future. First, premium coffee. Think Nespresso and Starbucks. Second, science-based pet care, like Purina Pro Plan. And third, they're aggressively trying to build a whole new growth engine in health science, vitamins, supplements, that kind of thing. This right here is the absolute core of their new strategy.
Okay, so let's recap. We've seen the fortress, we've seen the cracks that have appeared, and we've laid out the big plan to fix it all. From an investor's point of view, this whole situation boils down to a classic debate, the bull case versus the bear case.
So the bulls, the optimists, they'll tell you that economic moat is still incredibly strong. They'll say the strategy to pivot is smart and that spending more on marketing will bring customers back. For them, it's a great company at a pretty attractive price. But then you have the bears, the pessimists. They're arguing that Nestlé is just too huge to grow quickly anymore. They see a giant getting nibbled at by smaller, more agile competitors, and they think this big turnaround plan is super risky and might just not pay off.
So who's right, the bulls or the bears? Well, ultimately, the numbers will tell the story. And if you're an investor, these are the key things you absolutely have to watch. First, that real internal growth number. Does it get back into positive territory and stay there? Second, those profit margins. Is there a clear path back to their target? And what about China? Can they turn things around there? And finally, are those big bet innovations actually selling? The answers to these questions are going to tell us whether this whole pivot is actually working.
So you can see Nestlé is truly at a crossroads. Is it still that safe harbor stock, the unshakable fortress you can count on in a storm? Or is it a lumbering titan now facing the fight of its life to redefine its own future? We've laid out the data and the framework for you, but in the end, only time and more importantly, successful execution will tell us how this story ends.